In 2022, the combined crypto market capitalization declined from approximately $2.9 trillion to $800 billion, a loss of $2.1 trillion. The collapses of that year were not a single event but a cascade of interconnected failures. TerraLuna's algorithmic stablecoin implosion in May, Three Arrows Capital's insolvency in June, Celsius Network's collapse in July, and FTX's bankruptcy in November. What is striking to any experienced financial risk analyst is how recognizable the failure patterns are. These were not mysterious, novel catastrophes unique to crypto. They were leverage, fraud, collateral misrepresentation, and governance failures, the same structural deficiencies that caused the 2008 global financial crisis, the 1998 LTCM collapse, and the 1997 Asian financial crisis. For institutional investors, the analytical challenge is not explaining these crashes in hindsight but building due diligence frameworks capable of identifying the warning signs before the unwinding. The chronology of major crypto crashes reveals escalating complexity but consistent root causes. The 2014 metric tons GOX collapse resulted from private key mismanagement and internal fraud at what was then the world's dominant Bitcoin exchange. The lesson was ignored. Counterparty risk at centralized exchanges remained underappreciated for a decade. The 2018 ICO collapse was classic speculative excess, billions of dollars raised for projects with no technology, no users, and no revenue. This was the dot-com bubble dynamics applied to token issuance, with no SEC registration requirements or disclosure standards. May 2022 brought TerraUSD and Luna's catastrophic implosion. The algorithmic stablecoin's design contained a fatal flaw. In a bank-run scenario, the mechanism to restore the peg required inflating Luna supply, which destroyed Luna's value, which further destroyed confidence in UST, creating a death spiral that evaporated $40 billion in 72 hours. Three Arrows Capital and Celsius followed in June and July, with excessive leverage and concentrated exposure to Luna-related assets creating cascading insolvencies. November 2022 delivered the FTX collapse, arguably the most consequential because it involved outright fraud by a well-regarded, institutionally connected exchange. $8 billion in client funds had been transferred to Alameda Research, FTX's affiliated trading firm, without client consent. Three root causes appear, in some combination, in every major crypto crash. The first is inadequate or circular collateral. TerraUSD was backed by Luna, Terra's native token, creating a circular dependency where Luna's value depended on USD maintaining its peg, and USD's peg depended on Luna's value. Under stress, this circularity becomes self-reinforcing to the downside. Any structure where the collateral supporting a claim is itself dependent on the viability of that claim is fundamentally fragile. Traditional institutional investors recognize this as analogous to a bank using its own equity as its Tier 1 capital, structurally unsound. The second is opacity and fund commingling. FTX's collapse revealed that customer funds held at the exchange had been transferred to Alameda Research for proprietary trading. No institutional investor could have detected this from public information alone. It required investigative journalism and a whistleblower. The lesson is that unverifiable custody assertions from unregulated entities must be treated as high risk. The third is leverage without oversight. Three Arrows Capital borrowed from over 20 counterparties while concealing its total debt load. Each individual lender believed its exposure was adequately collateralized. The systemic leverage was catastrophic. In the absence of centralized clearing, which traditional derivatives markets use precisely to prevent this, crypto lending creates invisible systemic leverage. The FTX collapse is the definitive institutional case study in crypto counterparty risk. On October 31, 2022, FTX was valued at $32 billion, had raised capital from Sequoia Capital, SoftBank, and the Ontario Teachers Pension Plan, and was led by a founder who was ubiquitous in Washington lobbying circles and institutional conferences. 7 days later, it was bankrupt. The sequence began on November 6, when CoinDesk published a report on Alameda Research's balance sheet, revealing that a large portion of Alameda's assets were held in FTT, FTX's own exchange token. Binance CEO tweeted that Binance would sell its $529 million FTT position. This announcement triggered approximately $6 billion in withdrawal requests from FTX within 72 hours. FTX could not meet those redemptions. The reason, as the subsequent bankruptcy proceedings revealed, was that FTX had transferred at least $8 billion in client funds to Alameda Research for trading and investment activity, without client knowledge or consent. The entire edifice collapsed within a week. For institutional investors, The lesson is not that FTX was unique. It is that the warning signs, concentrated token treasury, lack of independent audit, offshore jurisdiction, founder-controlled governance, were available to anyone who asked the right questions. 4 pre-investment due diligence steps can identify the conditions that precede major crypto failures before they materialize. Step 1. Verify asset segregation in writing. The FTX collapse was possible because clients never verified that their funds were legally segregated from FTX's proprietary assets. Require a signed legal confirmation, reviewed by independent counsel, that client assets are held in segregated accounts with documented audit trails. Step 2. Identify circular token economics. Before investing in any crypto product whose yield, stability, or collateral depends on a native token, model what happens to that token's value if the product experiences significant redemption pressure. If the model shows self-reinforcing deterioration, a death spiral, the product is structurally unsound. Step 3. Require independent audit. A platform offering yield, custody, or lending services that cannot provide a Big Four audit or equivalent independent verification of its balance sheet should be treated with deep skepticism. In the absence of audit requirements imposed by regulation, institutional investors must impose them contractual. Step 4. Assess leverage transparency. For any lending or yield-generating counterparty, require full disclosure of leverage ratios, collateral composition, and concentration limits. The Three Arrows Capital situation demonstrated that 20 sophisticated institutional lenders, each believing they had adequate collateral, collectively created a system that was catastrophically overleveraged. 3 warning signs appeared prominently before each major crypto collapse and will likely appear again before the next one. First, unsustainably high yield promises. TerraUSD's Anchor protocol offered 19.5% APY on USD deposits, a rate that, in a zero-interest rate environment, attracted $14 billion of deposits. The yield was not generated by genuine economic activity. It was funded by investor capital raised by the Terra Foundation, an unsustainable subsidy. When the foundation's capital ran low and yield was reduced, redemption pressure destabilized the peg. Celsius offered 17 to 18% on Bitcoin deposits, generating this through highly risky lending and DoFi strategies that clients did not understand. When yields fall below promises, the model collapses. Second, offshore domicile. Regulatory arbitrage through offshore domicile is a consistent feature of crypto failures. It reduces compliance costs and eliminates the oversight that would otherwise prevent fund commingling and leverage misrepresentation. Third, aggressive marketing spend and political access. FTX spent $135 million naming an NBA arena, sponsored Formula One teams, and employed high-profile celebrities. This level of marketing spend, when disproportionate to documented revenues, is a signal of a business model dependent on continuous new inflows, analogous to the promotional excess seen in Ponzi structures before their collapse. 5 institutional lessons drawn from over $2 trillion in documented crypto losses. 1. Counterparty risk in crypto is existential, not theoretical. Mt. Gox, Celsius, and FTX collectively demonstrated that even dominant, well-regarded platforms can fail catastrophically. The only defense is using regulated, independently audited, asset-segregating custodians for all institutional holdings. 2. Yield above risk-free rates represents uncompensated or undisclosed risk. No exception. Before accepting any yield offer in crypto, the institution must identify the exact source of that yield and assess whether it is compensated adequately given the identified risks. 3. Avoid all circular collateral structures. Any product where the collateral supporting a claim is also the beneficiary of the value of that claim contains a mechanical death spiral. This is not a borderline case. It is a categorical exclusion. 4. Assume leverage opacity unless demonstrated otherwise. In the absence of centralized clearing infrastructure, aggregate leverage in crypto lending markets is invisible. Conservative counterparty limits and collateral requirements are the only structural defense. 5. The single most powerful institutional protection against crypto crashes is structural rather than analytical, maintaining all assets at regulated, audited, segregated custodians and refusing to engage with unaudited offshore platforms regardless of their market reputation at any given moment. Learning from crypto's biggest failures is as important as understanding its biggest opportunities. Crypto mechanics provides the rigorous, institutional-grade analysis that separates disciplined professional investors from those who repeat the same mistakes. Subscribe now to stay ahead of the mechanics that matter.